If you recall, last time we focused on market comparables analysis. In this chapter on approaches to valuation, there are three categories of approaches. Market comparables approach, which we've covered already. We now turn to the cash flow adjusted approach, which is most likely going to be new to many people. And then we'll finish this chapter looking at discount factor adjusted approach. And so in the cash flow adjusted approach, it does require active trading based on something that we'll learn later known as self-financing dynamic replicating. The key insight on that particular strategy is it doesn't require any intermediate cash flows in the trading strategy. And again, we'll cover this in more detail, but there are heavy restrictions on the cash flow adjusted approach with regard to marketability. We require a high level of marketability. John Burr Williams, who posited the discount factor adjusted approach, assumed that marketability doesn't influence value, and he was clearly wrong, that we now know. That if it turns out mathematically, if self-financing dynamic replication is possible, then we can value as if traders are risk neutral. It's important to emphasize that we do not assume traders are in fact risk neutral. They can be risk seeking, risk averse, or any other kind of risk preference profile. But if self-financing dynamic replication is possible, then the valuation can be done as if the traders are risk neutral. The valuation under the cash flow adjusted approach is simply you project an expected future cash flow under a unique alternative probability measure or risk neutral probability measure or equivalent martingale measure. It goes by many names. Basically, I'm going to sum over these expected future cash flows where the expectation is taken from a fairly objective approach, and then I'm going to discount by the risk-free rate. And so the way this typically works is I have a state space at each point in time, and I take the likelihood of a particular state occurring at a particular time, and I take its cash flows, I sum across all the states at a point in time, and then I take the present value. The key insight of the cash flow adjusted approach is there are two objective items. They're not subjective. The risk-free discount rate and the future probability distribution of outcomes is assumed to be based on the objective probability beliefs. There's air quotes around objective because there still is some structure and assumptions, but basically these probability beliefs have to be consistent with something known as certainty equivalent. That is, what's the probability distribution such that its expected value would equate to the certainty equivalent on a discounted basis. Again, we're going to go into this method in much more detail in future chapters, but at the moment, the key insight is it is based on a distribution as opposed to the market comparables approach, but the distribution is not my probability beliefs, but a objective probability belief, and it's not my risk-adjusted discount rate, it's the risk-free rate. So the key assumption key assumptions are that there exists a stochastic process or processes that accurately depict the future potential outcomes. That is, the state space is well defined. There exists a trading strategy that produces future cash flows in each state identical to the security being valued, and trading costs and other market frictions are minimal. Particularly important is short selling is allowed. So to justify this, the price is simply something known as a state claim. A state claim is simply the present value of $1 up to point in time t times the risk neutral probability measure at state j at that point in time. If I sum across all states, if I sum across all time, I come up with the valuation, the cash flow adjusted approach to valuation. The absence of dynamic arbitrage implies that this relationship has to be true. Again, we'll look at this in great detail, particularly when we get to the binomial model. But let's take a look at a simple one-period binomial. And let's look at an option on a futures contract. Again, a futures contract is simply a marketable forward contract. A forward contract is just an agreement today to do something in the future. If you're unfamiliar with futures and futures options, you may want to review some preliminary materials that are widely available before trying to work through this material. But at this point, the main thing is that this is a unique approach to valuation, not found in sort of the business valuation literature or the market comparables approach. So there are three markets now. If you recall, the futures put call parity had four. We eliminate the put option. We assume it doesn't exist. So we have the call option market, we have the futures contract, and we have financing. And we assume a binomial framework where there's two arcs. We have a single node today, and there are two nodes at the futures expiration date, or the futures options expiration date. And either up will occur or down will occur. Again, we're going to go through great detail later. It turns out you can parameterize this model, and again, I don't want to get bogged down in a lot of calculations, but with a certain set of assumptions that are covered in the book, we can build a rational binomial tree within the cash flow adjusted approach. U is simply the total return if up occurs. D is the total return if down occurs, or the price relative. And basically, it's what we apply to the futures price today to get the price if up occurs or the price if down occurs. And we have an objective way to assign probabilities. Notice that this 14.13% is not my belief that up will occur. It's the equivalent martingale probability that up will occur. Down is simply 1 minus the up. So a few selected calculations. Again, we'll be looking at delta extensively when we get to the options chapter. But just for the moment, assume that there's this thing called delta, where we have the change in the call divided by the change in the futures. That we can estimate a certain amount of financing. The no arbitrage value can be found by solving for the appropriate call price. In this particular case, it works out to simply be the expected future cash flows of this option, where the expectation is taken under the risk-neutral probability measure and discounted at the risk-free rate. So in this particular case, this particular data, we come up with 65.79 cents. An alternative way to get the exact same calculation is to compute what are known as state claims, the value of $1 if up occurs, the value of $1 if down occurs. With these two state claims, we multiply by the payoffs in those two states. And if you'll notice, this call option valuation approach gives me the exact same number as the equivalent martingale measure approach to valuation. And so the key insight, if I'm going to apply the cash flow adjusted approach to valuation, transaction cost assumptions are critical. I have to do a lot of transacting. It requires assumptions regarding the future behavior of the underlying instrument. When we get to option valuation models, we'll take a deep dive in assuming the underlying distribution is log normal or assuming the underlying distribution is normally distributed, and look at some of the differences in option valuation. We made no assumptions about whether traders are risk-seeking or risk-averse. This particular approach to valuation does require intermediate trading, and so we assume a level of liquidity that's quite high. And if you think about during the great financial crisis of 2008, 2009, oftentimes trading dried up. Well, trading firms that were valuing based on the cash flow adjusted approach to valuation had a real struggle because this active trading was no longer feasible. Strong beliefs on the direction of the underlying may in fact influence the spot price, but it will have no influence on the derivative due to arbitrage. And so if everybody believes, say, the futures price is going to go up, then the futures price will go up, which will cause the related options to also go up. So in summary, the cash flow adjusted approach to valuation, we assume a dynamic replication of future cash flows, which is often we can get really close to it, and with certain instruments like options. It does provide some risk information that we'll see later based on the equivalent martingale measure. It is based on the assumption that I can do self-financing dynamic replicating. I learned many years ago that in some countries it is against the law to finance arbitrage activities. Well, I can't do self-financing dynamic replicating if I have no access to financing. And so it's not surprising that in those countries, derivative valuations change. This is widely applied in the Black-Scholes-Merton option valuation model. It is also used in the binomial option valuation model. These two models will be extensively studied when we get to the options chapter, and the related risk information will be covered in the part of the book of the static risk measures, and then the final part of the book, the dynamic risk measures. Different applications of this approach will be used. You can also apply this particular structure to real options analysis. This is an interesting area of quantitative finance. If I'm trying to value a new pharmaceutical product, it's going to go through, say, 10 phases. At the end of each phase, there's a decision that has to be made on whether to terminate the particular product or to continue. And you can model based on this cash flow adjusted approach to these real world kinds of problems, which opens a whole new way to value very challenging projects and products in order to apply rational decision making on whether to continue or to stop the process. So up to this point, we've covered the market comparables approach, which is extremely accurate in valuation when it's available, but it provides no risk information. We've now covered the cash flow adjusted approach to valuation, which is very accurate, assuming I can do this thing called self-financing dynamic replicating. The cash flow adjusted approach has the advantage of also providing selected risk information. It's not exactly correct, but it's close and extremely useful. And so what we'll do in the next video, we'll begin to cover what's known as the discount factor adjusted approach, and we'll apply this to valuing a stock. And so I look forward to your participation in the next video.